G'day expats and welcome to another episode of Expat Chat, episode 134. God, we are climbing those stairs in the way of episodes. Today, you are joined just with me, recording a special episode while Brett Evans, the Managing Director for the EMEA region, is just on some personal leave. I myself, James Ridley, the Managing Director for the APAC region. Today, I'm going to be talking about a few Q&As that we've received within our Australian Australian Expat Financial Forum Facebook group. There's been some great questions. There's been a bit of a key theme lately around property transactions. So I thought I'd talk about that. And it's timely because we do have our webinar kicking off next month on the 5th of March with Jeremy Harper, the Director for Atlas Mortgages, as well as a buyer's agency firm, Henderson Advocacy, providing some terrific property insights which are forthcoming throughout later this year. We've been really lucky to receive a rate cut back in Australia. They're finally starting to cut rates, much like everyone else around the world that's already ahead of us. So it'll be very interesting to see what that does to the property market and the flow and impact of that. So if you're not aware that we've got that webinar, please jump in the show notes or jump on our website, navigate to events and register, because there'll be some terrific insights coming out from that one. There'll be session 1 as well as session 2. Session 1 will be for the EMEA region and session 2 will be a bit more tailored for the APAC time zone as well. A quick disclaimer before I run through some of these questions. Anything you hear today should only be consumed as information purposes only, and I guess entertainment purposes only. It should not be construed as personal financial advice or tax advice for that matter. Should you need personal, tailored financial or tax advice, you should seek that advice from a registered professional, whether it's a tax lawyer, a registered and qualified Australian financial planner, a mortgage broker, or a tax agent, such as Ben Turner from the Atlas Tax team. Now, there seems to be a key theme within the group around some good questions on selling properties, buying properties. So I thought today I would address a couple of questions, and I've also noticed a bit of a theme around how is superannuation taxed in the UK by the HMRC when you withdraw from it. So a very easy question, but not very easy to work out. So it's really important you work with a UK tax accountant on that one. Let's jump into it. And a really important update for our listeners which are unaware that might be looking to sell a property back in Australia whilst you're a non-resident is the foreign resident capital gain withholding tax legislation. So if we are a non-resident and we're selling a former main residence back in Australia or an investment property, and that property is over $750,000, then we would have had to withhold 12.5% of that sale price or the capital gain, and that goes straight to the ATO, and it's essentially prepaying the tax before the tax year is up. Now, that was the old rules. Those rules came to an end as of the end of December 2024. The new rules are actually a little bit more punitive, but remember, it's just prepaying the tax. When you lodge your tax return, if you've overpaid the tax, then you'll get a refund. But it's really important to focus on the time value of money. That money is better off being in your pocket, so you can invest it or put it in your offset account or whatever it might be, put it into your superannuation, rather than sitting in the ATO's slush fund, which I love to commonly refer to as. The new rules that are in effect is 15% of the property transaction value, and there is no, I suppose, minimum property price now. So it's not $750,000, it's on any price. In the event you believe that that withholding of 15% is going to be too severe based on the potential taxes you might have to pay, then you can seek a variation through an accountant or a clearance certificate if it's actually your main residence and it shouldn't be treated as taxable at all. But if we are selling that asset and we are a non-resident, it will get captured by that provision, the foreign resident capital gain withholding provision. And if it's a case that we might need to consider reducing or unwinding some of the potential withholding taxes, prior to that sale, you should have your accountant ready to go so they can do the variation certificate for you or even a clearance certificate for you if you haven't made a capital gain. So that way, there is actually no withholding applied. They brought this piece of legislation in a long time ago, and it was mainly to capture foreign investors, not necessarily foreign residents, but foreign investors that had no intention of probably coming to Australia or even living here long term, They were buying property and then they were selling, and they weren't doing their Australian tax return, and therefore the ATO was missing out on a significant amount of tax revenue. So therefore they brought in the foreign resident capital gain withholding, so it captures it on the property transaction through when it settles through a common system like PEXA, goes to the ATO automatically, and therefore you're prepaying the tax. You'll get the tax back once you lodge that tax return. So it's very important to be mindful of that. You know, the tax can come back to you to a degree, depending on what the actual taxable capital gain of that property transaction is. So just important that you do a bit of research and do a bit of maybe a what if analysis on the property transaction beforehand as well. So you're just better informed and you can do some tax planning around that. So a good question. A question here, which I might have actually answered, but what happens if you were non-resident when you bought the property but become a tax resident, then sell years later? Also, the ATO guidance calculation on the link above is based on the full sale price as opposed to the gain portion. This seems incorrect. Yeah, so they're talking about here the foreign resident capital gain withholding, but what they're saying here is that they bought a property as a non-resident, so they're living overseas, then they want to sell it as an Australian tax resident. Will the foreign resident capital gain withholding still apply? So no, it wouldn't apply in this instance, because at the time of transaction and signing that contract of sale, you are an Australian tax resident. So it would be very easy for you to just get a clearance certificate. So no withholding tax comes out of that transaction. Remember, it is only trying to capture foreign residents, which are typically coined as non-residents of Australia. It's not trying to catch out Australian tax residents. In the event there is some sort of withholding that's applied, it's probably a case that maybe your conveyancer hasn't done the right thing there or has missed a form to complete there. So that's an important one to bear in mind. Next question. What is the current CGT situation if you sell an investment property in Australia that once was your main residence? So selling it as a non-resident. So good question. We're still seeing a lot of these questions pop up, especially with a lot of consults we're doing with Aussies overseas. So it's really important to remember that they have removed the main residence exemption for foreign residents. So a foreign resident is a non-resident, so an Australian living overseas, an Aussie expat, yep, falls under that same definition. Now, unfortunately, back on the 30th of June 2020, that's when the legislation kicked in. So as of 1st of July, if you sold your main residence or your former main residence and you're living overseas as an Australian expat, a foreign resident, then you would have to pay capital gains tax on that property transaction. They announced this update back in 2017, and it took a long time to actually gain momentum and finally become legislated. It was very punitive. And I know personally, I had a couple of clients obviously selling up their main residences, putting those funds to work in whether it was their superannuation or share portfolios, or even using the capital for a new main residence overseas, depending on what the exchange rate was doing at that time. And it was a terrible time because we also had COVID. So there was a big question mark on the property market as well, what was happening there. So with that in mind, going back to the original question, if you're living overseas and your main residence is now an investment property back in Australia and you sell that property, you are not entitled to the main residence exemption. The only entitlement you'll be able to benefit from will be that period of ownership that you lived in it and that you were an Australian tax resident at the time for the ownership period that you were Australian tax resident. You will be able to apply a discount to that period of ownership. So it's often beneficial to get a valuation certificate when we exit Australia, because that can help demark that period of ownership as an Australian tax resident. And that's where we can use what's called the 50% CGT discount concession and apply it to that period up until when you leave. Now, it's really hard to know whether we're going to sell that property whilst we're overseas. Obviously, a change in circumstances is probably likely for this person that's dropped this question. But you can do a historical valuation. You can engage a firm to go back, look at the data, look at the property, look at comparables, and they'll provide you a formal report with what the valuation would have been at that time that you left Australia. The longer you leave it, so if you're getting one, say that was done in the last 3 years, it's likely to cost you anywhere from maybe $500 up to $1,000. If it's significantly historical, going back, say, 20 years or something like that, then that will cost you maybe $1,500 up to $2,000, depending on the type of property as well. So yes, hopefully I've answered that question really well. Another unique question here. Hi. Question regarding money transfers from the United Arab Emirates back to Australia and tax residency. If you regularly transfer large sums of cash back home to Australia into your savings account, is there a risk this would be deemed by the ATO as a sign of your intention to go back and impact your tax residency? It's a really good question. And often what we try and encourage our clients to do when they're sending money back to Australia is give that money a purpose. So a purpose is putting it into, say, an offset account attached to a mortgage. Putting some funds into superannuation, if that's the right kind of strategy for you. Putting the funds into a term deposit, because that's a type of investment back in Australia. Or even investing the funds, putting it down for a deposit on a property or investing in shares. There's a lot of different avenues. Right now, this individual might just be saving for a deposit on a property. So you want to try and give it a purpose rather than being overseas for 10 or 15 years and just sending money back and just accumulating a very large savings amount. Currently within the tax residency rules, because we haven't moved to the modernising tax residency rules where there's those important 4-factor tests, there is still always going to be, with the old tests, the domicile test, they'll look at sort of your connections back to Australia. So that's an important one to bear in mind. But on the surface, I wouldn't say that sending money back is make or break for tax residency. It'd be a lot of other contributing factors that would have an impact on your tax residency. So probably not enough information in that question to go on. With the new proposed tax residency rules, just remember that one of the factor tests is Australian economic interest. So that can be savings within a bank account. There's rumours it was an Australian super fund as well, connections to maybe a trust. They still need to legislate a lot of the details there, and they've probably gone back to the drawing board, and we might see that pop up again in the next 12 to 18 months. They might revise them and give us a bit more detail, especially that 45-day rule test, which was very punitive. We'd like to see that be pushed out to 60 or 90 days. I know a lot of us were lobbying for that, just because 45 days is very punitive, especially for those individuals and Australians that are residing in countries which don't have a tax treaty in place, which often is a lot of Middle East countries. It's a lot of European countries. There's some Southeast Asian countries as well, which cover off. So it's just one of those things that we're keeping a very close eye on. So watch this space. Last question for today to touch on was UK tax on super. So a very convoluted topic, and it's very hard to deep dive into how your Australian super, when you turn it into a pension and you start withdrawing from it, if you are a UK tax resident and you're withdrawing from your Australian super, how that is taxed by the HMRC. So that's the ATO equivalent over in the UK. The UK does have some unique rules, and if you've been accumulating a large balance within superannuation and it's going to be a great provider for your income stream in retirement, then I would highly recommend you do seek some UK tax advice, because often in order to give you the best outcome, they'll actually want to break down your your superannuation account based on the time that you contributed to it, and apportion the balance for different periods. So usually any balance that's grown in your superannuation up until the 6th of April 2017, that portion of your account can be tax exempt from a withdrawal by the HMRC. And then any amount after that, when they made a legislation change, is taxable by the HMRC. But you can't elect to your super fund that you only want to withdraw from, say, the pre-April 6, 2017 amount. You're going to be withdrawing an amount and it'll be prorated based on sort of the percentage of the makeup of your account. So tax does apply to the withdrawal of your Australian superannuation fund, but it's dependent on the balances and the contributions made prior to that date, 6th of April 2017, and after. So it's prorated, and that's really important. A lot of people get hung up on whether it's taxable or not. Certainly is taxable. Unfortunately, our tax treaty doesn't really provide relief on Australian superannuation funds. There's always relief usually given on Australian government pensions. So that would be such as maybe a Centrelink pension or Australian government service pension, as an example. But they're pretty rare here in Australia. It's often Australian superannuation is the main one, or you might receive a defined benefit pension from, say, the Commonwealth Superannuation Fund, which is the Australian government super fund, those sort of things. But in this instance, tax does apply on your Australian superannuation withdrawals when you're a UK tax resident, but it is very important that you use a UK tax account to break down the proportions of your superannuation fund, because some of it will be tax-free, but some of it will be taxable. So based on withdrawing, say, $50,000 out of a superannuation account worth $500,000, yep, a portion of that 50,000 would technically be tax-free if a lot of the contributions were born about pre-6th of April 2017 contributions and growth, and any amount after that would also be taxable. So they need to work out, okay, we're pulling out 50,000, then we need to know what percentage is pre that date and post that date, and then that's what would be taxable. Because we don't have any tax credits on Australia to use, because when we pull funds out of our Australian superannuation fund, and we are fully retired, met our preservation age, it's usually an income stream which is tax-free. It doesn't land in your income tax return. You have to report on it. So there's no real tax credit for you to take over onto on the UK tax side, I should say. Obviously, in Australia, we get the benefit of that 15% concessional tax within super when we're on accumulation mode, which is terrific. But when we obviously turn into a pension, it's all tax-free. So it's hard to translate a tax offset over to the UK. And that's why in this instance, it's usually a portion of it still taxable. So very, very convoluted and tough topic, UK tax on superannuation withdrawals. And that's why it's really important that you engage a UK accountant to help you break up the account so they can work out what's taxable and what's tax-free or tax exempt. There's also some other rules in play, especially with the FIG system, I should say, the FIG scheme that exists over in the UK. That's relatively new, giving you 4 years essentially to clean up your affairs before foreign income and foreign assets become taxable. That's another one, and I'll be getting Adam Prentice, our UK specialist, on to talk us through that one in the coming weeks. It's a great episode. Keep an eye out for that one. In the meantime, keep an eye on the socials, as we do have that property and mortgage webinar coming up next month. And that's it from me today. A couple of questions, and we'll see Brett back on the next episode. Thanks for your time, guys. Speak to you soon.